January 2025, the CFPB, the federal agency that oversees banks and lenders, studied buy now, pay later users. Heavy users carried $871 more in credit card debt than comparable consumers who never used it. None of it showed up on a single credit report. The villain is one rule inside the Truth in Lending Act. That law built every protection on your credit card. Buy now, pay later. Companies designed their loans to dodge that rule on purpose. Here is the rule. Buy now, pay later is built around. The Truth in Lending Act protects loans with interest or loans stretched past 4 payments. Buy now, pay later splits every purchase into exactly 4 payments with no interest. The loan exists. Legally, it just doesn't count as one. The pitch to merchants was simple. Shoppers spend more when the pain of paying splits into 4 pieces. Merchants pay a small fee, and checkout completion rises enough to cover it. Within a few years, the option appeared at almost every major checkout online. Not labeled as a loan, labeled as a convenience. A credit card must show you the interest rate up front. Buy now, pay later doesn't have to, because the law says it isn't credit. A credit card must let you dispute a charge for a broken product. For most of its history, it didn't have to offer that right at all. A credit card issuer must check whether you can actually repay the debt. A buy now, pay later company can approve a loan in seconds. It has no real way to see what else you owe. A credit card application can be denied if your debt already looks too high. A buy now, pay later. Loan almost never is. Credit card lending is regulated the same way nationwide. Some states require a lending license for buy now, pay later. Many states don't require one at all. A credit card sends one monthly statement for everything you charged. Buy now, pay later. Keeps a separate ledger for every provider. No one sees the full picture across all of them. Meet Jenna. She's 27, paid partly in tips and partly in shifting gig app deposits. She doesn't think of any of these as debt. Each checkout screen called it 4 easy payments, 0 interest. Jenna isn't reckless with money. She checks her bank balance every single day. She has 3 buy now, pay later loans open right now. Klarna for a coat, Afterpay for a phone screen, Affirm for groceries. One app added the grocery option at checkout last month. None of those 3 loans appear on the same statement. None of them appear on her credit report. Each company only sees its own 4 payments, not the other 8 she owes elsewhere. Her Klarna payment came due the same week as rent. She missed it. The payment still tried to pull from an account that wasn't there. That triggered a late fee from Klarna. It also triggered an overdraft fee from her bank. 2 fees from 2 companies that never saw each other coming. She didn't notice the missed payment until the overdraft alert came. By then, both fees had already posted. Jenna didn't stack 3 loans by accident. Nothing in the system was built to show her she was doing it. Jenna is not a rare case. She is the pattern regulators started measuring at national scale. Multiply Jenna by every shopper running 3 or 4 of these loans at once. That's millions of people carrying debt no single lender can see in full. Start with scale. In September 2022, the CFPB studied 5 of the largest buy now, pay later lenders. Between 2019 and 2021, the loans those companies issued grew 970%. 16.8 million loans became 180 million. Dollar volume grew even faster, 1,100%. $2 billion became 24.2 billion. Late fees rose too, from under 8% of borrowers to over 10%. Growth slowed after that, but it never reversed. By 2023, 6 major lenders issued 335 million loans. That volume totaled $45.2 billion. 53 million people used at least one of these loans that year. That number kept climbing, not shrinking. The average loan is small, about $135. Small enough that no single payment feels like real debt. The same federal research found something else. People who use these loans are more likely to already carry heavy credit card debt. They're also more likely to rely on payday loans and pawn shops. An ability to pay check, the step that confirms you can afford a loan before it's approved, exists for a reason. It's supposed to catch exactly this pattern. Someone already stretched thin, taking on one more loan they can't see clearly. The same report found BNPL borrowers carry lower credit scores on average. They're also more likely to have missed payments on other loans already. The second proof point is the regulator's own reversal. In May 2024, the CFPB ruled buy now, pay later counted as a credit card. That ruling meant cost disclosures. It meant the right to dispute a bad charge. It meant real billing protections for the first time. Then, in May 2025, the CFPB reversed itself. It announced it would not enforce its own rule. The rule was formally withdrawn months later. The agency's own explanation for reversing was telling. It called its prior rule, quote, procedurally defective. It said the loans don't fit the credit card framework it had tried to apply. The protections existed for about a year. Then the same agency that wrote them took them back. The third proof point is what's happening to borrowers right now. LendingTree's 2026 survey found 47% of users paid late last year. That rate has climbed every year for 3 years straight. The same survey found 63% of users have held multiple loans at once. 1 in 4 had 3 or more running at the same time. The same survey found 68% of users say the loans make them overspend. 54% said they need the loans just to make ends meet. Among the youngest borrowers, the numbers are worse. More than half of Gen Z users missed a payment last year. 3 different sources point at the same gap: a federal report, a regulatory reversal, and a consumer survey. None of them point in a different direction. So here is what you actually know now. Buy now, pay later was never a new kind of payment. It's a credit card, built to dodge the rules your real credit card follows. Most users still think of it as free money, split into pieces. That is exactly how the checkout screen is designed to feel. $453 in hidden personal debt, $871 in hidden credit card debt. A regulator found those numbers, then almost fixed them. This is not a story about one reckless company. 6 major lenders, operating under the same exemption, produced the same pattern. That's not a footnote. That's the system working exactly as designed. For about a year, buy now, pay later had to follow your credit card's rules. Then the rule got pulled, and the gap reopened. Jenna's 3 loans are still invisible to each other. Nothing in the law currently requires that to change. The industry disputes that these loans are functionally credit cards. The federal government's own 2024 ruling said otherwise. So did its own 2022 research. The next checkout screen offering 4 easy payments will look ordinary. A button, a date, no interest mentioned. Picture the screen again. 4 boxes, 1 checked, a button marked confirm. It still looks like your decision alone. A federal regulator already mapped out exactly how that screen works. It also mapped out exactly who that design was built to protect. It wasn't you. But you now know what that screen is built to avoid telling you. You know the rule it was designed around. You know the year regulators tried to close it. You're not most users anymore. You know the rule, the reversal, and the year it happened. That is no longer just a gap in the law. It is a gap you can finally see. That missed payment didn't just cost a late fee. It also triggered an overdraft charge from her bank. That fee has its own hidden math. We already broke down exactly what that overdraft fee costs, expressed as an interest rate. Same playbook, a different institution, charging in the same shadow of the law. Watch that one next.